Comparison of currency translation for financial statement in Malaysia and Singapore. When translating foreign currency financial statement, both Malaysia and Singapore adhere to specific accounting standards that guide the treatment of foreign currency transactions. However, there are notable differences in their approaches, particularly in the standard that they follow and the implication for reporting. The first one was accounting standards. The Malaysian Financial Reporting Standards, which is MFRS, are aligned with the International Financial Reporting Standard, IFRS, specifically MFRS 121, which is based on IAS 21. These standards requires entities to determine their functional currency and translate foreign currency transaction using the spot exchange rate at the transaction date. Monetary items are retranslated at the closing rate at the reporting date, while non-monetary items are translated at historical rates. However, if Singapore follows the Singaporean Financial Reporting Standard, which is SFRS, which are also based on IFRS. The relevant standard is FRS 102, which similarly mandates that foreign currency transaction can be translated using the spot exchange rate or an average rate if fluctuations are minimal. Monetary items are retranslated at the reportings that exchange, while non-monetary items are carried at historical rate. Number 2 is functional currency determination. Malaysia, the functional currency is defined as the currency of the primary economic environment in which an entity operates. This determination affects how foreign transactions are recorded and reported. Meanwhile, Singapore, similar to Malaysia, Singaporean entities must assess their functional currency based on their economic environment. This assessment influences how they translate and report foreign currency transactions. Okay, number 3, translation methods. Both countries utilize similar translation methods, which was the first one was current rate method, temporal rate method, and the last one is non-monetary translation method. Current rate method, all assets and liabilities are translated at the current exchange rate, while equity items retain historical rates. Next, temporal rate method. This method considers both current and historical rates depending on whether items are monetary or non-monetary. And the last one, monetary non-monetary translation method. This method distinguishes between monetary assets which fluctuate with exchange rate and non-monetary assets which do not during translation. And the fourth one was reporting exchange differences. Malaysia, exchange differences arising from translation are generally recognized in profit or loss unless they relate to net investment in foreign operations, which are recognized in other comprehensive income. Meanwhile, Singapore, realized exchange gains or losses from foreign currency transaction must be reported for GST purposes. Unrealized gains or losses, however, do not affect GST reporting as they do not constitute a supply. And the last one was practical implication. Tax considerations in Singapore specific guidelines dictate how foreign currency transactions affect GST reporting, requiring businesses to maintain consistent exchange rate resources for tax purposes. Meanwhile, Malaysia regulation may not impose such stringent requirements on GST but focus more on financial reporting standard. For financial reporting, both jurisdictions emphasize transparency in financial reporting through adherence to international standards, but differences in tax implication may influence how businesses manage their foreign currency risks. Alright. In summary, while both Malaysia and Singapore follow similar frameworks for translation foreign currency financial statement under their respective financial reporting standards, aligned with IFRS, differences exist in practical application, particularly regarding tax implication and specific reporting requirements. Understanding these nuances is crucial for businesses operating across both jurisdictions to ensure compliance and accurate financial reporting. That's all from me. Thank you.